Was it a good investment? Hey, Nate with Keyrenter Property Management here, and I'm going to walk through with you an analysis of an investment property, a standard and typical single-family home that you can buy in a lot of markets for a good price, rent it out for a good rate over the course of 10 years. And we're going to look and see, as we consider management fees, vacancy, repairs and capital expenditures and other costs, and even some bumps and bruises along the way, if this was a good investment or not. And so we're going to first start with what the goal is for the investor. If you as an investor are looking for cash flow today and looking to replace your income, you might be more concerned about the initial flow that you got on your cash. How much money are you getting today? You may be looking at the wealth down the road, or maybe a mix of the two. If you're looking more for long-term wealth, you may not be as concerned about cash flow. In a lot of investments, give both, give one or the other. It's just important to understand what you're looking for. So here's our investment, 8125 South Happy Cir. This is a 4-bedroom, 2-bath, 1-car garage. It sits on a good sized lot, and we can rent this thing out for a good rate. We bought it for $250,000. Our total cash out of pocket was $60,000, which was including the down payment, closing costs, rehab costs of $5,000 for cleaning, maybe some repairs before we rent it out. And our monthly mortgage on that is $1,074 with a 5% interest rate. Okay, so pretty typical, pretty standard. We put 20% down to keep our PMI out of the equation and to reduce our interest rate a little bit here. Our income on this is $1,800. Okay, so we're going to keep it really simple with an $1,800 rental rate. Our monthly expenses, we have two categories. So we've got the fixed expenses, which is our taxes, our insurance, our management and leasing. We put 12% because we got management about 10%, and then some leasing costs. So pretty conservative numbers here. And we've got an increase of 3% on our monthly expenses and our rent, just keeping up with inflation on a yearly basis, which is pretty typical as we're looking at budgeting here. Now, our budgetary numbers, these are the items that we want to make sure that we're accounting for, but they're not guaranteed to happen. These are the things to help keep us safe and in the black. Okay, we want to budget for repairs and capital expenditures about 10%, so $180 of our $1,800 rent. Vacancy about 5%, $90 a month. Of course, these are monthly figures. So total budgetary expenses of about $270. Now, the management and leasing fee, you may be looking at your situation and saying, you know what, I'm just going to manage myself and not have to account for that, so I can maybe pay a little bit more or not have to rent it out, and maybe the numbers work a little bit better. But you got to consider management because you don't know what's going to happen tomorrow. You may be in a situation where you have to have someone come in and professionally manage it. Of course, as a property management company, we encourage you to do that from day one, so that you can free yourself from that burden and allow the professionals to come in. Okay, so our total operating expenses, including our budget and our fixed, is $656, which leaves us in year one with monthly cash flow of $70 a month. Some cash flow focused investors would say that's not great. That's not enough. But if we look at year 10, we're bringing about $420 a month after that period of time. Okay, so much better in the long haul. But let's look at this as we continue on. So we want to make sure that we're prepared for these 10 years. Of course, we've got our budgetary figures here, which often enough, the budget is enough to cover these repairs, these capital expenditures, the vacancy. And a lot of the time, that's all we need to have in place, and we're going to be okay. But you want to make sure that you're prepared for the unexpected items. We put unexpected in quotes because we always want to be sound investors and expect the unexpected. So we have a recommended reserve of 3 times the rent, or in this case, in year one, it's $5,400, which is 3 times $1,800. Of course, we're going to increase our reserve as our rents are increasing over the course of time. So let's fast forward 10 years, okay? So we had our budgeted repair and capital expenses of $24,762. That's a pretty good budget for repairs and capital expenses. If we needed to replace a roof, that may be increased, but oftentimes investors will sell their properties about 2 to 3 years before they have to do that. And then our budgeted vacancy, 12,381, which again is a pretty good budget for vacancy as well, as most tenants in these types of homes stay 2 to 3 years anyway. All right, so what is our return on investment after selling? This is factoring in all of our costs, closing costs, commissions, all those sort of things. It's 127% return on our investment, which is our cash investment in the very beginning we talked about, or a 12.7 average annual return with cash flow of $28,539. So was that a good investment? I would say that was a great investment. Yes, that's a good investment. That's a good rate of return on your money, and there's some other benefits that we'll talk about in just a moment. But it's important to keep your eye on the price throughout this process. So if you're unprepared without a budget, you're going to have some frustration. So you want to make sure you have those things in place, because there can be some challenges along the way, and it doesn't go exactly how you want it to go with these budgeted expenses in place. So let's talk about some of the unexpected things that could come along. Let's say that in the second year of this investment, the water heater goes out. It's a $1,000 replacement in addition to the budget of repairs you already had in place. In the fourth year, the tenant moves out unexpectedly, 30 days vacant, in addition to the already budgeted vacancy costs that you had in place. So this is $1,967 in the fourth year value of rent. In the seventh year, the furnace goes out, $2,300 replacement, again, in addition to your budgeted allotment for repairs and capital expenses. And in year 9, a tenant is evicted and leaves damaged beyond what is expected. $2,500 in lost rent, $7,500 in damage. And many investors, or I should say some investors along this path, when they hit these challenges, they get a little bit frustrated. And again, I believe it's because they weren't quite prepared. They weren't expecting the unexpected. And so when these repairs happen or a tenant vacates, they might get frustrated. They might decide they want to just sell the property and maybe put their money into mutual funds or stocks or put it in the bank or do something else with it. But again, if we're prepared for these things and we know that this can happen, and we look at the long run here and we look at the big picture of what we're wanting to accomplish, we don't get caught up emotionally in the situation, everything will be okay, as we'll see here shortly. Okay, so let's fast forward 10 years now, considering some of these unexpected items that happen. Our budget repair cost was $24,762 again, but our actual was $35,562. All right, so we went over budget. Okay, let's see what happens here. Budgeted vacancy $12,381, but we went over budget. We spent $16,848 in vacancy. All right, not fun, but let's continue on. What is our return on investment after selling? Again, factoring all the costs and everything there. Our return is still 106.4% return on our investment, with an 8.86 average annual return, cash flow of $13,000, just over $13,000. So was this a good investment? I would still say yes. It's still a great investment, not just for the cash return, but for a few other factors that I want to just share. You get tax deductions that are not accounted for in the return. You can depreciate the asset over the course of ownership, increasing your cash flow. I don't account for that in the return either, because once you sell, you may have some depreciation recapture that you can talk to your accountant about. And you have full control over your asset. This is a huge deal, you guys. If you have full control, it means that no one can take it from you. Where if you invest your money in stocks, mutual funds, paper assets, startups, whatever it is, you can't control what happens to that money, to your investment. Recently, there was a silver fund that was a great investment for many people here in the state of Utah. A lot of people invested in their entire retirement and their life savings because it was such a great investment. Well, it turned out it was a Ponzi scheme, and they lost everything. They had no control. Where with real estate, you can move into the house if you have to, if worse comes to worse. You can trade it, you can exchange it, you can do all sorts of things where you have full control over the asset. Of course, you can leverage it, unlike any other type of asset. But what about declining markets? Okay, a lot of people are worried about the market declining, they want to sell because they're worried what's going to happen with it. Well, if you look historically what's happened, we've always had an appreciating asset in terms of real estate. It has always gone up since the early, since the beginning of time, really. But if we look at this trend since the early 80s, it's gone up. Yeah, we've had some dips along the way. We had a bigger one here, but it goes up. So if we look at the long-term perspective and we're looking at things in the long run, it will work out. So I hope this has been helpful for you to look at this to see if this is really great investment. If you own rentals yourself and you're considering selling or doing something else because maybe you're hitting some of these challenges, I encourage you to keep a long-term perspective and recognize that real estate wins, every time compared to so many other investments that you can choose. So thanks for watching. Feel free to reach out should you have any questions. Happy to talk to you. Thanks and take care.